And then the other quote, which I'm sure we'll touch on, is a little bit on that, but sort of a nice, more poignant way of putting it, which is Warren Buffett's lovely quote that I know we quote lots in Teaminvest, which is that you always want to look for three things in a business partner. Someone who is honest, capable, and hardworking. And if they're not the first, you hope to God they're not the second and third, because they'll fleece you blind. And that's true. You know, when we're talking about ranking management, ranking executives of these companies, we want them to be honest so that they don't do the wrong thing. We want them to be capable so that they run our organization well. And we want them to be hardworking so that they're prepared to, you know, do the most with our capital. Yep. But if they're hardworking and capable and dishonest, that is the worst combination of the three, because the incapable, dishonest person tries to steal your money and doesn't get away with it. The capable and hardworking, dishonest person will take it before you've even realized.
Yeah. Welcome to the Teaminvest Wealth Builder podcast, where we help you build smarter wealth and make more confident investment decisions. Welcome back to this week's episode of Teaminvest Wealth Builders. Company management isn't something that we usually think about when we're talking about investing. But company management is something that is actually really important to understand before you invest in a company. If we want to truly understand a company, it's the management of the company that directs where it goes, what its values are, what outcomes it's trying to achieve. So it is something that's really, really important. But how do we go about looking at the company management? How do we go about understanding? And what are the questions that we need to ask to truly understand the management of a company? With me today, I have Andrew Coleman. Thank you for joining me. So this is a topic that we often discuss in Teaminvest, and we have a specific checklist set up to review company management. So let's start at the top. Why is it important?
Yeah, great question. So I think the first thing we need to do is disabuse ourselves of any notion that investments are tickers on a stock market or a bond exchange. At the end of the day, they are organizations, and like all organizations, no matter how much the AI bros would want them not to be, they are run by people. There are people at the top, there are people in the middle, and there are people at the bottom. And at the end of the day, those people have an inordinately large impact on the way in which things will run, even in businesses where you would think the people are not important at all. And that's just simply because humans have an incredible way of both inventing new things and throwing spanners in the works of things that are working if they are either unintelligent, disillusioned, or upset. You know, the reality is that the experience you have with an organization as a customer is driven as much by your experience dealing with the customer service rep from the Philippines on the phone as it is about any product or service they give you. And so, you know, let alone anything that's happening at the top of the management, right? So from that point of view, we need to just throw out this idea at any point that the organizations are organizations, some big behemoth that operates in some form of technocratic way. It's people, they make decisions that are driven by all the joys and problems of being run by people, and your interactions with them are human at a human level. Yep. And so from that point of view, the culture of the organization, the trustworthiness of the organization, the intelligence of the people in it, all of those elements go a long way into affecting how we react with those companies as customers, and therefore buy their products and what margins we pay, how suppliers interact with them and what terms they will offer, the decisions management make around capital allocation, their ability to attract leaders and great staff. All of it in the end is a human question, even though we may sometimes like to tell ourselves it's the numbers or it's technology or it's intellectual property or it's a big factory with machines. It's not. They're humans operating them.
Absolutely. And I think it might be a good place to start to see the actual impact, firstly, that people can have on companies by using some examples maybe where we've seen big impacts. And then we'll actually delve into how to assess the management.
Sure. I think the first thing maybe to do is, I love quotes, right? So let's maybe start with a couple of quotes because I think they help frame the conversation nicely. The first one is a lovely quote from Benjamin Graham originally, which I'm paraphrasing, but is effectively on the lines of the management of a business that you invest in are like your business partner. And you need to treat them like a business partner. They may not treat you as a business partner, may not care about you. You may just be a shareholder and passive. But the reality is you need to look at them as if they are taking your hard-earned cash, which they are,
Yep.
and deploying it in a business that you co-own. And so the first step has got to be, would I give that management my money in the first place? Are they honest, capable people? Do they have a track record of doing well with the money other people have given them? Or are they perhaps the more Christopher Skase, Alan Bond type example? And we can talk about lots of examples of those. And I think they're very top of mind for people where someone has unethically or incapably lost shareholders' money or bondholders' money.
Yeah.
The second thing is to point out that the reality is in all of the studies in leadership, and there's huge amounts of leadership studies, we know two things about leadership, and really only two things. The first is that leadership really matters. Organizations where there is a leader who is perceived to be a very good leader outperform, whether that's in politics, in war, or in business, or in academia, and organizations where the leadership is disliked or considered incapable underperform, no matter what scenarios they're given. The other thing we know about leadership is that there is no actually really good way of predicting who's going to be a good leader or a bad leader. So unfortunately, there's no simple, easy methodology that says, give them this amount of ingredient of intelligence, this amount of ingredients of ethics, this amount of ingredients of charisma, they will be a good leader. It's not at all like that. It really is a case of leaders rise for the times they're in, and they can be a good leader in one period and an awful leader in another. And there are plenty of historical examples of that. The famous one that most of us will probably know from our schooling is, of course, Winston Churchill, who was a poor leader in World War I, a brilliant leader in World War II, and a brilliant thinker, but an awful leader in the period following World War II. So from that point of view, these are great people at the extreme end who rise to the challenge of their times or fail in the challenge of their times, that has nothing necessarily to do with any individual ingredient.
Right.
And we can talk about that, and I'm sure we will, because that's the second thing to look for in management. And then really the third thing is that just to remember that these are humans. They are motivated by human concerns, which include things like their family life, any distractions that are going on outside the office, whether they like people or not, how they're paid, so their remuneration and the way in which their remuneration is structured and the way in which they restructure remuneration about others will create large impacts. So, there have been famous examples, and again, we can go into them, of organizations that have destroyed themselves with poor remuneration decisions because it created behavior that they didn't actually want. And on the other hand, organizations that grew off the basis of having simple, good remuneration structures. So from that point of view, we've just got to remember, as I said before, that these are humans and they act in human ways. And we know that as humans, leadership matters, character matters, culture matters, self-interest matters. We are conflicted, we are weird, and there is no easy way to predict who's going to succeed or not. But what we can do is see traits that we know are either indicators of likely future success, or more accurately, usually likely future failure, because it's usually easy to pick where they're about to go off the rails rather than when they're on the rails. And then also, in the end, trust the fact that as humans individually, we may not be great at picking these things, but the wisdom of the crowd means as a group, we tend to see through people quite well. And, at the end of the day, accept that people change. That's the other thing as well. I think that's one of the challenging things about investing, and probably relationships in general, if you think of investing as like a monetary work relationship rather than a love relationship, but it's there. The person you marry or date is not necessarily the same person 10 years later. Things can happen in their life that change them. Things can happen in your life that change you. And so the management or executive that is brilliant for a company at one point may not be brilliant 10 years from now for the same company, or similarly may have different motivations and drive them in different ways, which is often hard to accept as an investor, but we've got to be there.
Yeah.
And then the other quote, which I'm sure we'll touch on, is a little bit on that, but sort of a nice, more poignant way of putting it, which is Warren Buffett's lovely quote that I know we quote lots in Teaminvest, which is that you always want to look for three things in a business partner: someone who is honest, capable, and hardworking. And if they're not the first, you hope to God they're not the second and third, because they'll fleece you blind. And that's true. When we're talking about ranking management, ranking executives of these companies, we want them to be honest so that they don't do the wrong thing. We want them to be capable so that they run our organization well. And we want them to be hardworking so that they're prepared to, do the most with our capital.
Yep.
But if they're hardworking and capable and dishonest, that is the worst combination of the three, because the incapable, dishonest person tries to steal your money and doesn't get away with it. The capable and hardworking, dishonest person will take it before you've even realized it.
Yeah.
And I think that's often the challenge as an investor. You know, the world tends to get caught up in charismatic people, in charismatic stories, and they may often be the ones who are very capable and hardworking, but maybe lack a little in the honesty.
So when we do get this wrong,
Mm-hmm.
what can be the outcome for companies?
Well, they go bust. Or shareholders' wealth is materially crimped. And I mean, there are famous examples of this all through history. But I think taking some of the extreme ones away, but just examples that I think will resonate with people listening to this, I've just put down a few examples, 6 examples of companies where I think they ended up as failures for investors off the back of management error. So I'm not even going into full dishonesty mode. We'll have that as well with some of these stories, because quite often happens with people who are high achievers, type A personalities, is when things aren't going well, rather than confronting those scenarios, they can fall down the pit of being dishonest to try and cover it up, which then creates even more problems. But I think in all 6 scenarios, despite who they are in some cases, they didn't actually set out to be dishonest. What happened is they made a mistake, and then human elements snowballed and created those things. And there's 6 examples that as Australians we all probably know quite well. So the first, and I'm just going through them in order of when they occurred, is the Alan Bond PBL saga, of course, when he bought out Packer. The second is the Kodak example around digital cameras. The third is Lehman Brothers. The fourth is Babcock and Brown. The fifth is Forge Resources, and the sixth is Magellan. Now, these are all quite topical examples of management doing poorly, and we'll talk about examples of management doing well, I think, afterwards. But they all share some elements in common, and what they all really have is that problem of that confluence of people that we talked about before. So none of these companies or people we're about to talk about were failures. None of them were incapable, because if they'd been incapable, they would never have got big enough that people would have bothered to invest in them in the first place. You know, the person who's a complete idiot and cannot run a business doesn't raise capital from anyone. They don't get the money. Everyone sees that they're incapable. So I think the first step is the capability question. Most people are pretty good at answering as investors. You know, have you made money before? What does your business do? Do you have customers? Are they paying you good money? Are you constant, you know, are you up to date with your taxes? There's some pretty basic questions we can all ask, and we do ask, that means I think the capable question I'm going to take as given. That may be wrong, but I'm going to assume we all understand it. And the same thing with hardworking, because the obviously lazy executive, no one really wants to give them money, right? You know, we're pretty easy to pick up on the person who's clearly not, or they're shirking their job, right? So again, I'm going to leave that aside, and we're going to focus on that third piece of that idea of honesty, hubris, you know, that idea of, are we aligned together? Because I think that's the one where as investors we can get caught. And if you look at all of those examples I mentioned, and we'll go into them in a little bit of detail, they were all examples of very capable, very hardworking people that made some really dumb decisions that had massive implications for investors. None of those decisions, with perhaps the exception of Alan Bond, were ever driven with the idea of hurting anyone else. So they weren't unethical people. They became unethical in their outcome, because in order to keep things going, they started making unethical examples. And that's why I've left Enron off, because Enron was completely unethical from the beginning, right? It was a scam. But these are businesses that were ethical, tried to be ethical, and blew it up because of the humans. So if you take the Alan Bond example, I mean, Alan Bond became one of the greatest corporate crooksters in Australian history, right? We all know the story of Bond standing there in the dock after, you know, a few years after the Australia's Cup Challenge, pretending he couldn't remember anything and he was completely unable to recall, and his mind had gone, and then a few years later popping up as the chairman of a new university, right? But how did he get there? He got there because he was actually a really brilliant businessman. He built a number of really successful businesses, and he did some really incredible things, the Australia's Cup Challenge, of course, being one. But he got caught up in hubris, this idea that everything he touched turned to gold. And he started to enter more and more industries where he actually didn't know a lot, which is the classic hubris, the Icarus myth, you know, flying closer and closer to the sun. And of course, the famous one that finally brought him undone, for the story of those remember, is that he bought PBL, Packer Broadcasting Limited, Channel 9, etc., off the Packer family, Kerry Packer, who at the time, Kerry Packer said at that price, famously he was quoted as saying, you only get one Alan Bond in your lifetime. And effectively what happened was that Alan Bond, as the story goes, saw in PBL, Channel 9 and all of the newspapers and magazines, the ability to continue to grow the rest of his businesses through self-promotion, got so caught up with being a media personality post-Australia's Cup success that he completely overpaid for a business, did it with a huge amount of debt, and in the end, that mistake brought down the empire. And it brought down the empire because as things went south, he tried to cover it up more and more by using more debt and doing more dishonest things in order to avoid admitting his mistake.
Yeah.
Now, that's very human.
Yeah.
And I think, unfortunately, when we look at our kids, toddlers as an example, we see that play out across all of humanity. You know, the classic thing of your kids caught with chocolate around their mouth. They know they're not meant to be eating chocolate. And you ask them, did you take a chocolate?
No.
What is the what's the first thing that every kid? No, I didn't, right? There's sort of something innate in our psyche as humans that when we make a mistake that we know we shouldn't have made, our first reaction is not to admit the mistake, it's to deny the mistake at all. Yeah. And that's cute, if annoying, when your 4-year-old does it. It's frustrating when your 14-year-old does it. It's problematic when your 24-year-old does it. And when your 48-year-old CEO does it, it's run for the hills.
Yeah.
Because that's when the money is really going to get blown up. So that's example number one. Example number two, of course, is the Kodak example. I mean, for those who don't know, probably most of our listeners are of the generation that remember Kodak film and going in and printing out taking your photos and then printing out with the film. But Kodak really was one of the world's most valuable companies. They had a cornerstone position. They were the number one provider of all film and of all cameras. And this was a huge, huge market. They also happened to be the first company to invent digital film. They invented the digital camera. And what they did was they looked at the problem, the management board, it's a very famous case study, you could look it up online, looked at what the digital camera was likely to do to film as a medium and realized that it was going to cannibalize this incredibly profitable business. And so they were left with a choice. Choice number one, announce the digital camera and digital film, realized that it was going to materially shrink their business, but they'd remain number one potentially in the space of cameras and film, but be much smaller, or put it in the top drawer and hope that no one else cracked the code. Now, we're self-interested as humans. Board members tend to have tenures and management that is a couple of years, maybe 5 at maximum. What do you think they did? Well, they did what humans will do. If I announce it today, I'm the CEO and board that presided over a shrinking business. If I put it in the top drawer, I hope no one else will ever invent it, and I'll be okay. But even if they do invent it, the odds are it'll take more time for them to come up with it than my tenure in the organization. So I won't be the one that killed Kodak. Some other poor sucker will be the one that killed Kodak or presided over a shrinking business. Is that right? Well, in hindsight, no. But the human. And I can understand the human element sitting around that table very well to say, well, this crackpot in the team has come up with this new thing called the digital camera. We don't know if it'll take anything up or not, but if we announce it, we know it'll hurt. So let's not announce it. And they bought themselves about another decade. But when the digital camera did become widely available, I mean, now it sits in our phones, but the digital camera originally, what happened to Kodak? They were one of the world's 20 largest companies. You'd be hard-pressed to find them in any meaningful size anywhere in the world anymore. And that's the challenge of the second problem. So Alan Bond, hubris. In the case of Kodak, denial. We like to deny, as humans, or we want to deny epoch-changing events when they occur to us because the thing we've got, we're onto a winner. It's the same problem that happens when someone gets diagnosed with a medical condition that's relatively early stages and puts off treatment. You know that the long-term pain may well be worse by putting it off and the impact may be greater, but there's a very human innate nature to not want to confront the problem now, kick it down the road. Yeah. And that, of course, is bad with our health and it's very bad with our wealth. So that would be number two. The third example is the Lehman Brothers example. Now, of course, most of us will probably remember the GFC in great detail. We were working through it. But the Lehman Brothers example is one of these amusing ones that has become, Bear Stearns is worse, by the way, in terms of as an interesting story, but we'll use Lehman for this example, has become told as a story of corporate greed, which it was to some extent. But we've missed the main learnings, I think.
Okay.
Because the main learnings of the Lehman Brothers example was an organization, a very storied investment bank, who decided to follow the market because the peer pressure got too much. So Lehman Brothers historically was not one of the leaders in subprime debt. They had stayed away from subprime debt. They didn't believe securitization was a particularly big and interesting thing. And they were constantly, you can go back and look this up, in the early 2000s, mocked for being too staid, too boring, and not going too heavily into this new asset class that was making Goldman Sachs and Bear Stearns and JP Morgan and all of these others huge amounts of money, BlackRock and Northern Rock. And so what happened? Management eventually decided we can't hold our line too long. This is hurting us too much. We'll get into the market too. And of course, in typical nature, the wrong time to buy into the bubble is at its peak. And so Lehman Brothers entered the subprime crisis and securitization at almost exactly the wrong time. Over-leveraged themselves, bought all of the worst assets because at that point the junk was floating around, all the good stuff had been taken, and of course collapsed spectacularly and brought down much of the financial system with it. Which is, to me, the third example of problems with management, which is management that believes in that lovely old line of, I don't know if it's Harold Wilson or Harold Macmillan, but about his political opponent of, he is a man of very strong principles, and if you don't like them, he has others. This idea that peer pressure can deviate you as anyone being human from what you believe in when eventually it looks too scary to miss out. There's too much FOMO. So one of the challenges that I think we should always ask about our management teams when we're looking at investing in them is, are they prepared to hold the line even when everyone else is saying you're a fool? Because the irony is the ones who move early, even if they're right or wrong, they tend not to blow a lot up because they haven't paid the overpriced amounts.
Yep.
The ones who move last, the ones who get caught up in the peer pressure right at the end, they are the ones who don't have the systems in place to deal with it if it goes wrong. They're the ones without the deep knowledge of the asset class, and they're the ones who probably paid the most and have the most to lose. And so from that point of view, what I'd look out for in management teams is when the market is getting exuberant about something, are they the kind of management team that either goes early because they believe in it or says, don't understand it, don't believe in it, I'm staying away. Not the kind of management team that says, we weren't in it in its early days, but now that everyone else is in it, let me go in hard, because they're the ones who are going to blow your money up, like Lehman Brothers. The fourth example that I wanted to talk about a little bit in there is Babcock and Brown. Babcock and Brown, of course, being the big Australian casualty of the GFC. And Babcock and Brown, I think, is a really great example of that idea of the Dunning-Kruger effect in action. Now, for those not familiar, the Dunning-Kruger effect is this idea that as we learn about a topic, any topic, we start to gain an outsized amount of confidence relative to our actual knowledge. So we feel like we're an expert, armchair expert. And then as we learn more and more over time, actually our confidence decreases rather than increases. And so what we actually have is this really toxic problem that when we know a very small amount about something, that's the point when we have the most confidence about our knowledge.
Yep.
So the true expert always says, well, I think it's this, but there could be other factors. The person who knows nothing just says, I don't know anything. The dangerous time as an investor or a management team is when you're saying, I know a little bit, but I think I know everything.
Yeah.
Right? And Babcock and Brown was a perfect example of that, where brilliant financial structurers had worked out how to make a lot of money in a few markets. And as they grew, took on more and more leverage and expanded into more and more markets. Now, everyone tells the story of Babcock and Brown as a story of leverage going bad. And of course, that's what in the end brought them down. But I think the real story of Babcock and Brown was a bunch of accountants and investment bankers thinking they could run operating assets as broad as childcare to power generation. Because it's one thing to invest as a lender or an equity holder into businesses that broadly with management teams in place who really know them. You know, there's risk around it, but at least you're separating yourself. But the real story of Babcock and Brown, of course, was that every time they bought one of these assets, they changed the board and management to their people, which worked for a while until the Dunning-Kruger effect came home to roost and it stopped working. And it's that classic problem that a true expert in an area, when something goes wrong, knows what lever to pull. So even if they can't fix it completely, they'll at least limit the damage. The problem is when you're an armchair expert and something goes wrong, not only do you not know what lever to pull, but your confidence probably means you'll pull the wrong lever. So you'll make the problem worse.
Yeah.
And for those who know the story of Babcock and Brown, that played out sort of in sequence, almost comically, one after the other across their assets as the debt became harder and harder to sustain.
Right.
The next example is Forge Resources. Now, this is one that Teaminvest members may know personally, not just, I mean, they might have known all of them personally, but because it was a company that for a while, about 20 years ago, 15 years ago now, passed the filters. So, looked like it had great return on equity, achieved with little or no debt, strong and growing earnings, high stability, and a good management team. And Forge was a really good business in a niche. And then Forge got the idea that they could buy a distressed competitor up and run that business better than they had. Now, that has often been a very, very good investing strategy. So on the surface, looks great. The difference is Forge decided to do that in a completely different geography and a completely different industry to the one they operated in. And in that lovely sort of old saying of the one who wins the auction is the one who comes second, that's exactly what happened. Forge ended up materially overpaying for a business that had contract risks that were much greater than Forge understood, contract liabilities that Forge didn't have the ability to meet, both financially and in engineering expertise, and in the end blew up the entire business. Those failures of the business that they acquired were so large, contract liabilities in engineering often are, they can be many orders of magnitude of the size of the contract, that it took down not only the business that was acquired, but the original Forge business as well. Now, we often tell that story about hubris or dishonesty because it then got covered up along the way. They tried to produce accounts that pretend things were going better. But I actually don't know if that's the case with Forge. I just genuinely think, looking back on it, that they didn't realize what they had bought. So they weren't trying to lie to people. They just didn't put the numbers on the balance sheet because they didn't think that was going to happen. It was the black swan event. Yep. They were unable to understand by going beyond their circle of competence that they had inherited a greater risk than we do. So to me, that's an example. We talk about it, about management being experts in their area of competence, but non-experts outside their area of competence, and doing that classic human thing, we're talking about humans, of understating big risks and overstating small risks. So Forge got all the basics right, but they missed the big picture. And often management will do that. So, we can talk about lots of other examples, I'm sure people can think of them, where management ran a core part of their business really well, but messed up on the peripheries, and maybe not as spectacularly imploded as Forge, but certainly destroyed a lot of shareholder wealth. So we talk about in our checklist is, has management destroyed shareholder wealth on grandiose acquisitions or acquisitions outside their area of competence?
Yeah.
And then lastly, Magellan, which of course has been very more recently topical with what happened to Magellan and Hamish Douglas, because I think that's such a great example of taking a business with strong moats, manageable risks, and it still has relatively strong moats and manageable risks, but where the distractions of the management team on areas outside of the business can hurt the business in ways that you don't understand. Now, what I'm about to say is all public records, and I feel heavily for Hamish Douglas, but Hamish Douglas went through a crisis of life. I won't call it a midlife crisis because I don't know whether you'd call him midlife, but a crisis of life, right? Where effectively Hamish realized that he was in a marriage that didn't work for him because he was actually attracted to a different gender. And that played out in a very messy behind the scenes divorce and crisis of his own views in life, and resulted in, at exactly that moment, unfortunately, because it was at the same time around the COVID pandemic, some pretty poor decision-making, or more accurately, lack of decision-making, just when the business needed things to be done. And in the net result, effectively meant that many of the customers lost confidence in the business. And as we know, once your customers lose confidence in your business will struggle. Yeah. And so that's a great example of where the numbers look good. The person wasn't dishonest. Yes, he probably had been caught up in hubris and a large amount of the Dunning-Kruger effect as well. And we can talk about that in a whole separate one. But really what brought Magellan down from a shareholder perspective was the investors in Magellan products losing confidence in Magellan's products. And that wasn't driven by Hamish making comments about the pandemic that he maybe should or shouldn't have made. Most of those didn't care. That was management teams across institutional investors looking at it and saying, he and his team are distracted. They're not focused on the business and we can't afford that. Let's pull our money. And in the process, turned what was a potential risk into a real risk. Yeah. And so I think as investors, that's that final point that I would raise, which is we sometimes want to see these management teams as boards as monoliths and robots. And we look at their track record only, and we look at their public pronouncements only, but we forget they're humans and things outside of their business life will affect them. And then we make excuses for it. And a classic one at the moment, of course, is WiseTech, and we can go into that in MinRes, of course, as well. But I'm not going to talk about them today. But these are two examples where, yes, they are truly amazing entrepreneurs. Yes, they built a wonderful business. But at what point are their distractions outside of the office actually impacting the business? And it's very hard to tell as an investor because you're not in the room. None of us would have known how distracted Hamish was.
Yeah.
We only found it out after the thing started to fall apart and Hamish had to leave because he was too distracted. So, at what point can you tell that? And really the best way to do that is amusingly listening to rumors, which is dangerous, but you sort of start to pick that up around you.
Following the incredible success of our standout event in Sydney earlier this year, we would like to extend a warm invitation for you to attend the Emerging Wealth Winners Conference, Melbourne 2025. This event will be held in the iconic MCG Members Dining Room. We're bringing together a standout lineup of only 7 curated ASX-listed CEOs to present the insights, the knowledge, the shared wisdom, and the strategies that help inform investors making wiser decisions on when and where to invest into. This event is sure to be jam-packed, full of the knowledge and the wisdom that you're seeking, and we encourage you to register at tipgroup.com.au. Check out the events page, and we look forward to seeing you there.
And so I think those are sort of the main pitfalls around management. But what's interesting is if you sort of ask, how do you identify them? Because I think that's what really matters, right?
Good question.
And I think they really boil down to a couple of things. I think the first is watching how management interacts with their shareholders. Because at the end of the day, shareholders are theoretically, we are, the owners of the business. So how do they treat their boss? Do they react to their boss and treat them like they're on the journey, partners together? Or do they talk down to them, yell at the analysts, explain things, defend? The second is, how truthful are they about both their wins and their mistakes? Everyone likes to be truthful about your wins. It's that lovely old saying, success has many fathers, failure has none. But when something goes wrong, are they prepared to admit it's gone wrong and address it? They don't have to necessarily stand up there and say, mea culpa, I effed up, right? But do they at least address it? Or do they try and pretend it's not there, sweep it under the rug and move on? The third thing is look out for hubris. Whether it's the hubris that brings them down, like Icarus flying too close to the sun, or Oedipus, which of course is the famous Greek tragedy about hubris, at the end of the day, hubris kills. We don't know why necessarily as humans, whether it's distraction, whether it's we start to believe our own hype, but it does. Once a management and board starts to think that they're the masters of the universe and they can do no wrong, run for the hills. It never ends well.
How do we recognize that?
The way in which they talk about things outside their area of competence would be my view. They start to become experts on areas that you think, geez, what do you know about that? Or they start to say things like, there is no better business in the world but mine. That would be lovely if it's true. And I think we all believe our baby is the most beautiful. But at the end of the day, there are others out there that are just as beautiful, right? We have to accept that. Or our people are the best people and there's never anyone else working for anyone else who's any better. Like, okay, be scared.
Yeah.
Babcock and Brown is a good example of that one. But Hamish and others too. Obviously, you'll run for the hills if you see any dishonesty or incapableness. So we're not talking about those. And then the last one, and one where it's actually really easy when you know what you're looking for to see these things, but it's hard to do because we don't tend to look, there is look in the remuneration reports. So why do I say that? And we talk about this a lot at Teaminvest, but at the end of the day, we know that self-interest is a very powerful motivator, whether it should or shouldn't be, right? And so this isn't a question about skin in the game. That's we talk about that another time. This is simply look at what does management and the board say about how they believe they should be remunerated, what targets they believe are appropriate, and how they construct that. Because a management and board that is focused on growing a company in the areas that matter for shareholders and believes in shareholders as an equal is likely to be able to describe their remuneration in quite a clear and succinct manner. There's a whole bunch of legalese, but it'll be something along the lines of, our management team needs to win when the company shareholders win, and therefore we will reward them based on a share of profit or achieving certain targets and not taking on too much risk or whatever. That's a pretty simple thing. It's what you'd want them to be. Where there's a problem is one of two things tends to occur in the REM report, in my opinion. The first is they start to change targets year on year. Last year, we were going to remunerate based on X% growth. This year, it's on Y%. Either because now hubris has kicked in and we're pushing our targets out, or we're playing shareholders for mugs and moving the targets around just to suit us. Both of those are bad. They're bad in different ways, but they're both bad.
Yeah.
So that constant chopping and changing of targets between years, to me, is an immediate red flag. And the second thing is, what are the targets that are used? Because as the targets move from easily measurable, identifiable, simple things into more and more complexity, you can be certain two things are happening if there are people. Firstly, the people being incentivized by that remuneration are starting to go, it's too bloody hard to work out what I'm going to get paid. So they start to discount the value of the remuneration. So, that old joke of if you can't work out your bonus stopped at the traffic light, you probably don't think you're going to get your bonus.
Yeah.
So they may start to look for a new role, and whether that's the CEO or people under, that's never good for an organization to lose your top people. But secondly, with complexity comes the opportunity for people to hoodwink or bend what's going on. If your remuneration is really simply X% of net profit, audited net profit, okay, there are some games that can be played with the audited figures, but in the end, it swings and roundabouts. What you gain in one year, you'll lose in another, right? If your remuneration is based on a balanced scorecard, including share price, culture, ESG targets, targets we're not telling anyone about, undisclosed targets, that sounds to me like a recipe for a strong CEO or board member to just do whatever the hell they want. And I'm not saying they will. They're not necessarily dishonest people, but when they have something go wrong, are they going to perhaps deny it because, hey, I can sweep it under the rug, call it an abnormal and move on? Are they going to react the way we want them to react, or are they going to feather the nest? Because at the end of the day, if the difference is a couple of $1 million in my pay, I think we'd all love to believe that people are ethical enough that they won't do it, but human history tells you they probably will.
Yeah, and that's a strong motivator, right?
Absolutely.
Okay, so now we've highlighted the things that can go wrong and have gone wrong, and how to recognize those things. Do we have a good news story?
Yeah, absolutely. I think it's the corollary of that, right? It's the flip side, which is great management that is honest, that is capable, that is hardworking, will end up making you more money than you can imagine. And you see that play out across wonderful companies all through history, right? We talk about moats a lot and risks, right?
Yeah.
But at the end of the day, a moat has been built because someone in that management team saw that they needed a moat and was prepared to put the hard work in to move the dirt.
Yeah.
You don't get moats because you just they arrive one day from the clouds, right? It's not the 10 commandments given on the mountain, right? Like, you actually have to do something to create those moats.
Yeah.
So a great management team that inherits a business with weak moats over time will make those moats very strong and very wide. And therefore, the business will not only grow, but it will get safer year on year. And that's something that I think we underappreciate as investors. A business that has a strong moat, that is investing in that moat, the moat doesn't remain the same strength, it grows. And therefore, the stability of that business increases with time, not decreases. It's sort of this idea in management science often that the bigger something gets, the more risky it becomes. Well, no, the bigger something gets, the more competitors it will engender. There's a bigger prize worth taking.
Yeah.
But it depends what they've done with that money. If what they've done with that money is paid out in dividends and not bothering investing in their moat, then when the new army appears on the horizon, they got a problem. It is risky. But if what they've done is put a big amount of the money aside to add turrets, add crocodiles, put on new ballistas, then when the army appears, they're pretty safe, right?
Yeah.
So from that point of view, what the management's doing with the money as they get bigger, great management will invest in the future, which means widening the moats further, and they won't get caught out by competitors. There's always, I suppose, something that could happen weird and wacky that changes it, but on general, they won't get caught out by competitors. Poor management will. So scale is the enemy of poor management and the friend of good management. The second thing that also happens is that good management, who are not hubristic, and that's not always easy to maintain, will attract around them even better people. Because we all want to work around people who are like us, who are, driven if we're driven, if we're lazy, they're lazy, intelligent if we're intelligent, etc. And so an organization that gets bigger with strong management that presents an opportunity for the next generation to rise will attract an incredible crop of talent in the next generation. And that, again, reduces their risks going forward. It reduces key man risk, it reduces risks in other areas. And, if you've only got to look at Amazon and Apple and Microsoft as examples of that, where for all their other, questions, they have built a culture of attracting incredible young talent and keeping it. And that has, over time, meant that they've expanded and grown well beyond their initial product set and their moats in greater ways. On the other hand, you can look at plenty of businesses that had an incredible moat, but the leadership at the top was stale, didn't want young people, considered them to be, pimples and annoyances, and then found that those young people had set up a competitor somewhere down the road and eaten their lunch. So, that was always the case. So I think from that point of view, it's like anything investing. The great with time are rewarded and become greater. The poor with time are penalized and become poorer. So from that point of view, the rewards of getting it right as an investor are orders of magnitude greater than the risks of getting it wrong. You can only lose 100% of your money, but you can make 10, 20, 30 times your money when you get it right. They're not the challenge, though, I think, because I think you can tell the great management often and see it in the numbers and they're there. The challenge really for an investor is understanding when great management is not great anymore.
Okay.
Because that's the really risky one, right? Like identifying a bad management team and not investing in it, you don't lose any money. You might miss an opportunity if the share price rises, but you haven't lost anything, right? And identifying great management who remain great and bring through the next generation, well, great.
It's a good thing. Yeah.
The problem is what happens when great management goes bad, either because they themselves get caught up in these kind of examples we talked about, around hubris, around Dunning-Kruger effect, around ethics, all of these things. Or when someone that we thought was great management turns out to be not great management, but just lucky. Julius Caesar and Napoleon are both supposed to have quoted apocryphally that, they'd rather have lucky generals than good ones. And it's true, it works. Luck will take you a long way. Because at the end of the day, the outcome is what matters, not how you got there. If you're fighting a battle and you got lucky and won, who cares? The cricket joke, doesn't matter how you scored the century, you scored a century, right? But at the end of the day, luck can only take you so far. Eventually, you need to be good. And so, businesses that have invented a great product at the right time or got lucky in a market or whose management seemed to be brilliant, the question you've always got to ask yourself is, are they still brilliant today for what the business now is? Not were they brilliant to get it here? And I think that's that entrepreneur's paradox that we so often see in the market, is that great entrepreneurs will build a business up to an incredible level off the back of their own drive, their own intelligence, their own success. And they will keep doing so until, in the words of Cyril Northcote Parkinson, they rise to the level of their incompetence. The business now gets too big for them or too complex or in too many different areas. And then the challenge is, can they let go?
Yeah.
Can they bring in competent people and share the load? Or do they hold on? Because the more they hold on, the bigger the risk becomes and the more likelihood you as an investor will suffer when they, like Icarus, have their wings melt.
So I think you've given us a lot to think about. And I think we've really opened up a topic that isn't often discussed. I mean, at Teaminvest, yes, we absolutely discuss it. And as we said at the beginning, we have a checklist that we go through to identify these things. And we keep going back. I think that's one of the keys that you've hit on as well. It's not a once off, I have a look at it and then go, okay, well, now I'm invested in it and I just leave it. Exactly. We go back and we have a look and we do research on a regular basis and figure out whether we stay invested or we need to look at other things.
And I deliberately chose those 6 examples because they were 6 examples of companies that all had achieved incredible things and all would have, had we had the filters at the time, passed the filters. So, Forge and Magellan did pass the filters. The filters didn't exist. I'm talking about our mathematical quantitative filters around what makes a good business for the others because they're before that period. But all of them would have almost certainly, I think, because I know the stories quite well, passed the filters. They were all wonderful businesses with high return on equity achieved with little or no debt, exception of Babcock, but, relatively little, they had incredibly high return on equity because they had no equity. But, incredibly high return on equity achieved with little or no debt, earnings growing at a rapid click with high stability, and management who in all cases, every one of those cases was seen as the pinnacle of good management in their era. The Kodak team were heroes. Alan Bond was a hero. Yeah. Lehman Brothers were one of the investment banks, the original storied 4 on Wall Street, was Lehman, Goldman, Citi and JP, right? That's the area, we forget about them now, but at the time they were one of the big players, globally. Forge was this incredibly well regarded, at least for a while, mining services company. And Magellan, of course, was for a while the largest fund manager in Australia. So from that point of view, these aren't piddly little startups that people got carried away. These are incredibly big businesses with incredibly well-regarded management who achieved incredible things until they didn't. Yeah. And the reason they didn't and why they're such great examples is in all cases, it wasn't that there was something fundamentally broken with the business. It was that the humans got in the way because we are human and we're run by humans.
We are. And we're just, sometimes just unpredictable.
Absolutely.
But look, thank you for joining with me today. I hope our audience has got some real keys to look at when you're reviewing a company and making the decision whether to invest in a company or not. I hope we've given you some keys and some tools that you can use to assess that company management. Is there anything that you would like to say in closing today?
Perhaps one thing which I'd say that individually, if you're unsure, one of the advantages we have in Teaminvest is we use the wisdom of the crowd. I touched on that before.
Absolutely.
And that's this idea that you can ask a friend. You know, you don't have to make investing decisions alone. If you see something about a company that makes you happy, which is good, or scared, which is bad,
Yeah.
you can always ask a friend to say, hey, read the same thing and tell me what you think. And it's amazing how often that fresh pair of eyes will help you understand something that otherwise you might have missed.
Yeah, because
advantage of
we always have our own biases, right? You may really like the person that's running this company, so you're going to have those biases. So that's actually a really great thing to do as well. So look, we'll leave it there for today. Thank you for joining us. And if you found this beneficial to yourself, then I'm sure that there are other people out there that you know that would also find great benefit from this. As we said, wisdom of the crowd. Let's get it so that we're all on the same path, at the same education level, looking for the same things, so that we can share that wisdom. Thank you for joining us. If you'd like to find out more about Teaminvest and some of the things that Andrew spoke about today, then jump onto our website at teaminvest.com.au, subscribe, and we will keep you updated with everything that we're doing. Also, make sure that you follow us on this podcast and across our socials. Thanks again for joining us, and thank you for joining us.
Thanks, Fleming.
The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs. Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.